delay this morning. This is Joseph Trevesani from Worldwide Markets. We will commence our webinar immediately, as in right now. Today's title is Down Under. I think those of us of a certain age, of which I know that Maurizio from from FX Street is, because he got the reference. I had originally written up the brief for posting this, referencing the Men at Work song. The title's actually Down Under. I always called it I Come From a Land Down Under. The reason I thought of it, aside from the obvious application of the title, is there's a line in the song that says, do you resent me because I come from a land of plenty? And there's probably no better description of the economies of New Zealand and Australia, although I'm going to focus on Australia today just because of a lack of time, than is a land of plenty. Both countries are relatively, certainly by European standards and even to some degrees by American standards, underpopulated, meaning that they have far less of a population than land can support. There seems to be, I have been to Australia, I have not been to New Zealand, although a very good friend of mine is about to take a tour around both islands, he and his family, around both islands of New Zealand, which is about as far as you can go, at least from where I live, which is in New York City, in the populated world. The only further place you can go is Antarctica, which is populated, but it's mostly penguins and other creatures rather than humans. The history of Australia is an absolutely fascinating topic. If you are interested, I will recommend a book. It's called The Fatal Shore by Robert Hughes. It is, to my mind, one of the greatest general history books ever written that I'm aware of, and it is hugely entertaining and an absolutely fascinating story. And it's a great book. I mean, it's a great read and it's a great book. Anyway, if you're interested, The Fatal Shore by Robert Hughes. The relationship of the Australian and New Zealand economies to the rest of the world has been one of largely, not completely, but largely, a provider of resources to the manufacturing centers of the world. Although I have a personal caveat to that, our espresso machine is from a company called Breville, and Breville is an Australian company. I don't know if they're still owned by Australians, but they're originally an Australian company. It's a brilliant machine. So it's not that there are not manufactured products from Australia and New Zealand. There are, of course. But with a few exceptions, none of which I can test at the moment, their economies are not possessed of the types of consumer brands that you'll find in the United States, that you'll find in Europe. The brands of consumer goods tend to be the kind that are perishable and locally consumed. Vegemite being the only one I can think of at the moment. So their position, their economic rationale has not changed a great deal over the past 30 years. But the consumer of their resources has changed tremendously. and I think you know where this is going, of course. This has switched from the manufacturing, consumer-driven manufacturing centers of the West to China. It is irregardless of the origin of China's own manufacturing capacity, which in many ways is transplanted or is formed of transplanted Western manufacturing concerns. When I go to buy a drill, I usually buy either Milwaukee, these are American brands. Usually I buy Milwaukee or DeWalt. Both are American brands. Milwaukee, you don't have to know, comes from the city of Milwaukee, Wisconsin. They no longer manufacture here in the United States. It is a topic which has become a very sore one for the electorate in large swaths of the United States. It is a topic which is very much front and center in the election, which takes place a week from today, on Tuesday. Now, I'm not going to today, actually, this is probably a good topic, although a very, very fraught one, but I'll just touch on it here. The idea, the economic cost-benefit analysis that is done, the equations of economists that I've spoken of many times, not always respectfully, as far as the conclusions go, very much applies to the idea of international trade. The basic idea of competitive advantage benefiting all, permitting lower priced and multifarious goods to flow around the world, is one that I don't think anyone can gainsay. You certainly can't gainsay it from a strictly econometrics point of view. If we can produce wheat or computers or medical equipment, we as Americans, at a lower cost and greater quantity and quality, and China or India or Britain or anywhere else can produce refrigerators or Jaguars, or as I heard of in Jaguars, I don't know where that pronunciation comes from, and then we trade them, then clearly everyone is better off. This is the oldest idea practically in economics. So why, you might ask, and I think many people are asking, and they're going to be asking a lot more after the end of, after a week is out, why is there so much resentment politically to the facts of this competitive advantage idea on the ground? And there certainly are. It is an enormous topic in this year's election. And I think one of the reasons is because, and this applies particularly to Australia, but almost in the reverse sense, the fact, or the facts, that the equations miss. And this is an argument you can make, you can take it back in a different sense, back to the Industrial Revolution and the rise of the groups called the Luddites, who objected to the dislocations and the poverty, but also the dislocations, mainly the social dislocations caused by early industrialization and factory work. There is a certain nostalgia for almost anything, and this is human emotion, that we grew up with, the world of our childhood. As children, I look at my children now, And one of the things that you have, my children are young, they're 8. One of the stronger emotions that you have is to preserve the joys, the innocences of childhood as long as you can. The grimmer facts, emotional and otherwise, of adult life seem to be something that will come to all of us sooner or later, and rather sooner, and there seems to be very reason to hustle along that particular transformation. A certain aspect of that kind of emotional need applies to this topic, to industrialization, to the dislocations that are going on now and have been going on for generations. And I speak of my country in the United States, in many areas of the Midwest, mid-northern country, upstate New York, many places. The United States, at the end of World War II, dominated the world industrially. Practically every other industrial nation was broke or destroyed, certainly throughout Western Europe. And for a generation, US manufactured products dominated the world. That was never something that was going to stand, and it did not. A similar transformation took place in England from the first industrial revolution as other countries caught up. This all enters into the idea of competitive advantage in trading, and for Australia as well. I'm going to bring this to Australia in a second to why it's been slightly different there. And let me give you a better chart to ponder on before we do that. Where's my Australia unemployment chart? Here we go. Okay, now you all know the history and the years here. So I'll show you, that's Australian unemployment rate from about 2000 to 2009. I didn't have, compare this mentally to say the chart from the United States or other places, the charts of Europe. Not the movement, but the scale. So when you factor in, we all live in democracies, well, most of us do. And in democracies, the wishes of the people and large groups of the people need to be both considered and answered. And one of the reasons there's such turmoil in the United States election this year is because a large group, a very large group of workers, people, have not had their needs, their desires accounted for within the political system for more than a generation. And that has certainly boiled over this year because there is a candidate who has spoken to that. I am not going, of course, to do politics here. I would enjoy it, but it is not my role. But in an economic sense, the dislocations of offshoring jobs, of moving jobs to China for competitive advantage, burst upon the political scene this year in the candidacy of Donald Trump, who seemed to be the only one who recognized that there was potential political movement here. The arguments for competitive advantage are real as far and inescapable, really, as far as the facts of the products delivered to the various cultures, the various societies. It's the argument of creative destruction. I think that term from the Austrian schools of economics, which is true. It's the buggy whip argument, basically. There's very little sense in 1910 of trying to say buggy whip, horse-drawn carriage, whip manufacturers. It's not that the people working or the people owning those firms are any less desiring or any less deserving of livelihoods. It's just that the inexorable movement of technology eliminates their jobs. That was a movement purely of technology. People were no longer using horse-drawn carriages. They were buying cars. The movement of jobs to, and not just American, but far, English and French and Italian, and probably Australian, although I'm not as familiar with the Australian manufacturing sector as I am with the overall economy, to lower cost manufacturing places is not really one of replacement technology. It's one of manufacturing efficiency and cost. It is a different type of development. When crofters, weavers in England were put out of work, home weaving, by steam-powered looms, it was, in a sense, a matter of efficiency. The steam-powered looms could produce vastly more with the same amount of inputs. And of course, the more you produce, the lower the prices. So from hand-sewn clothing, we moved very quickly to what are called now off-the-rack goods. The costs of the early industrialization seemed to a rural population to be horrendous. We've all seen pictures of children working in the great satanic mills, as they were called at the time. One thing which is forgotten, at least in comparison when examining these times, is that despite the what we would consider horrendous conditions of the early industrial manufactories, they were never at shortage of labor. And the reason is, which we often forget, the reason is the reality of rural poverty. The mills recruited voluntarily. They did not operate as the Royal Navy did during the Napoleonic Wars, with impressment. They did not, and that's where the term dragoon comes from. Dragoon being a particular type of horse soldier from the earlier eras. To dragoon someone is basically to impress them, to drag them away from what they are and force them either to be a soldier or a sailor. It was dragoons who did that, heavily armored cavalrymen, among others. The mills of early industrial Europe, and England in particular, did not do that. Their workers were voluntary. They were voluntary because they were seeking better conditions. As hard as that seems to us now, that's the case. The choice between staying in rural poverty and going to the mills was one that was made voluntarily millions upon millions of times by the people involved. So it works to put the economic equations into a social context. And that is part, of course, of what we're seeing in this election here in the United States this year, and also other places as well. I think this one is more specifically, our election here is more specifically focused on economic issues of the post-industrial base. How the election will come out, I don't know. It appears to be very, very close. We shall see. It will certainly be an interesting election night. And for all of you who are on live here, I plan on attending the, much as I did for the Brexit vote, no parallels. They're just two different votes. I plan on being here and blogging and posting throughout the evening as that goes. With the election apparently as close as it is, and it seems to be getting closer and closer and closer as we approach the date next Tuesday. There is enormous potential for market movement, just to let everyone know. As with Brexit and the British vote to leave the European Union, one particular outcome, Britain staying in the European Union, was priced into the market. And I think we have the same thing with all of the markets around the American election. There is one particular outcome that is priced in, and that outcome seems to be becoming less assured day by day. So it could be a very exciting, if not agnostic, night. So I will be here giving you my views and also my up-to-date news. We'll have all our TVs on around, and we'll all be sitting around, not all of us, but a number of us will be sitting around the trading room here, just north of New York City, as the election news comes in. And if it is, it's a big country. So if it is, I mean, the British election was decided by about midnight. If there is a close election here in the United States, it could very easily stretch on into the European trading day, which could be a lot of fun. Okay, so we have the dislocations caused by economic change. It is interesting as this applies to resource countries rather than manufacturers. And this is where we enter into the difference between Australia, let me find another chart here, and New Zealand. Again, I'm focusing on Australia here, where we did CB rates. Where's GDP? 3 GDP, okay. Here we go. And at that 6.7 number on the right-hand scale, I think you all know where we're going with this. What has happened with Australia, which is why I started, it almost just floated up to my mind, the idea of the Men at Work song, Down Under. I come from a land of plenty. Australia, because of, and New Zealand, but because of their position as resource providers, were able and did, and it's just logical, I don't know that they planned it, but as the heavy manufacturing centers shifted deliberately, both under charge of the Chinese development ideas from the late 80s, but more so into the late 90s and the 2000s, as vast numbers of Western factories moved their sites to China. So did Australia's. I mean, there was, I was reading something over the weekend about this great book on sailing ships. Roger Morris actually has written 2 books. He's a New Zealander, I think. Or maybe he's a British who was retired in New Zealand. I'm not sure which, I forget exactly. Called Atlantic Sail and Pacific Sail. And their history is beautifully illustrated with his paintings. And he's a former merchant marine captain, I believe. And I believe British naval officer. Of Western ships exploring the Atlantic and the Pacific. And I was reading the one about the Pacific. And one of the things that the great clipper ships of the early or the mid 19th century were built for was the Australian grain trade. So the middle of the 19th century, these enormous sailing ships, they were also built for the China trade, the tea trade from China. Actually, they were built for the tea trade earlier, and then they became grain ships from Australia. So in the latter part of the 19th century, Australia became, as one would expect, a great resource provider for the industrialized center of the world at the time, which was England, the leading industrial center. The reason the Japanese drive on the left rather than the right is because when they modernized with the Meiji Restoration and did away with the remnants of feudalism, they copied the industrial process and in some ways the industrial culture, what they considered to be the world's most advanced industrial nation, which in the latter half of the 19th century was England. So in Japan, they drive on the left. Everywhere else, they drive on the right. So Australia's history as a resource provider is not a new development. And it has continued. It lets, I mean, if you are a resource provider, it is far easier to adapt your economy to newly rising economic centers and economic powers than it is if you are a manufacturer. What do I mean? When England's early steam-powered looms were supplanted by, in many cases, American looms of the Northeast, either water-driven or steam-driven, largely water-driven here in the United States. What was the advantage? Well, in a harsher way, it's much like some of the advantages that German and Japanese manufacturers started exhibiting in the late 50s and early 60s. Their plants were brand new. It is expensive to build new manufacturing capacity. It is even more expensive to adapt old manufactories to newer and more efficient technologies. Example is open hearth furnaces in steel to Bestmesser converters. Different way of making steel. One is much more efficient and produces better quality steel. This was also another factor behind the movement of, specifically, I'm going to speak about American manufacturing entities to China. Not only did they have a cost advantage, and that includes, of course, the things, but it's cheaper to build the new plant, especially when a new plant is necessary to take advantage of advances in manufacturing processes, controls, all of the things that you need to do as a manufacturing firm to stay on top of quality, efficiency, and productivity. If you have a plant making refrigerators in Ohio in 1990, 1995, chances are that plant was built 20 or 25 years earlier. Even say 20. Right at the advent of the personal computer era, 1995. So if that plant was built 20 years before, in 1975, think of the technological changes applied to your industry that will be necessary. So if you're looking at replacing that plant, it suddenly becomes more than wages of the workers between here and China that are driving the decision. The actual capital investment to build a new plant is one of the contributing factors. So the drive for this type of change involves enormous dislocations, enormous amounts of capital. Take it and compare it to a resource provider, just say grain from Australia. In the 19th century, or let's use iron ore, because iron ore is a more industrial capacity, related to industrial capacity. So in the 19th century, Australia is sending its iron ore to England and maybe Germany. Germany has a lot of coal, but it doesn't have a lot of iron ore. As the 19th century wanes into the 20th century, where does all of that, much of that, or some of that anyway, iron ore start to go? It starts to go to the United States and to Germany, if you will. How much easier is it to simply change the destination of a ship to take advantage of changing developments in economic production, in industrial production, than it is to replace manufacturing capacity? So that is what I was thinking of when I was musing on the Men at Work song. It's a great song, by the way, if you don't know it. I'm assuming it's probably split along age lines here as to who knows this song, but you can look it up. It's a great song. That's an easy thing to do. And over again, it can be done. After shifting to the United States for 30 or 40 or 50 years, you can then simply reassign your ships and they steam off to Guangzhou or to Beijing or Harbin. Is Harbin a port? I'm not sure it's a port. In China. So Australia and New Zealand's positions as resource providers and resources that are not as prevalent, shall we say, as oil has proven to be. Until we had the discovery of the vast amounts of shale oil resources here in the United States and in Canada, petroleum producers had a similar ability to provide for their economies, Venezuela aside, of course, by simply adapting new destinations for their products. That ability of oil producers has been essentially eliminated by the process of fracking and shale oil development here in the United States, here in North America. But for Australia, for things like iron ore, which is a commodity that I did some research on at one time in my life, Australia has an enviable position. So let's look here at what we're comparing in GDP. This is, on this chart, we have Australia in white. We have China in yellow, you can tell from 6.7. And we have New Zealand in green. The pattern is essentially similar to what we'd see in the developed. I don't mean to contrast Australia is not developed. Any of these countries, really. There's a financial crash and recession in 2008, which plunged everybody's GDP off a cliff, and the recovery. These are year-to-year charts, so some of the recovery, that sharp up slope, and particularly vertical slope in 2009 and into 2010 is a product of the base effect. We all know what that is, so I don't have to go into that. But look what else is going on. And think and compare. I didn't put them up because the charts will look too confusing. But compare the levels of what we're talking about here Australia and New Zealand's GDP is on this graph right here, this scale right here. The bottom of that scale post financial crash is 2%, with the average being somewhere up here around 3, maybe a little bit more, depending, a little bit less here, a little bit more here. So compare that to the most successful post-crash industrial economy, aside from those two, the United States. Our top line average for that period is just a little over 2%. That is an enormous disparity. It doesn't seem like much, but when you talk about a 1 or a 2 or 2.5%, 1.5% difference in growth rates across modern economies, the absolute amounts are enormous. The absolute changes for people's incomes is also enormous. So on the scale that we're talking about, the macro scale, a difference between having a cap at 2% and a bottom at 2% is enormous. So what you're looking at here is the adaptability of resource-driven economies, when of course there isn't the glut produced by oil development. Now remember, throughout this period, commodities were first high and then collapsed. The collapse being recently, 2014, 13, 14, and 15, and now into 16. So the growth rates that you're looking at, with the base at 2 rather than the top, are growth rates produced despite sort of an enormous cycle in commodity prices. So as long as, and then look at, China, we don't have to, oops, sorry. Oops, that works, how about that? Look at China. Look at the comparison also between the Chinese growth rate, which once we get past the base effect, is somewhere around 10%, has most recently come in at 6.7. We're interested in the comparative movement here from 10 down to 6.7. The argument about, or the discussion, shall we say, about whether China's actually growing 6.7 or 5.7 or 4.7, which I personally think is far more likely, is not necessary to this comparative discussion. So the Australian and New Zealand economies performed as their resource destination, mainland China, percent decline, a one-third decline, a 33% decline. That did not, rather amazingly, if you take a look at it, dramatically affect the growth rates of the insurance companies. Let's look, of the economies. Look at another example of these things. These are central bank rates. Central bank rates. I have 5 of them up here, 4 of them up here. White, Reserve Bank of Australia. Yellow, Reserve Bank of New Zealand. Green, the Fed. And purple, the euro. I think there are 2 striking aspects of this chart. The first is, for much of the period, and including now, although diminished, is the absolute difference, the spread between the rates in New Zealand and the rates in Australia and the rates in Europe and the United States. Want to take a look at another one here? Where'd I put that currency chart? It's the reason we were delayed. Here we go. I had to get this chart in, okay? Remember the years we're talking about here, okay? So let me get this chart up. These are currencies. Everyone should be looking at the currency. Okay, so in 2009 and 2010, and into 2012 and somewhat in 2013, the Kiwi and the Aussie reached all-time, well, generational at least, highs against the US dollar. On the currency chart, we have China, the Yuan, the Aussie in yellow, and the New Zealand dollar in green. So as this period here, when they're at their heights, what else are we seeing? I think we know the answer. Right here, 10, 11, and 12, we have the absolute spread, especially versus the dollar and the Fed, of those currencies over, of their interest rates over those of the United States. Even though it doesn't seem like it much anymore, with all the other news out there and all the other names we call things, quantitative easing and bond purchase and all this stuff, the basic driving cycles of currencies remains the spread, the comparative rates of these central banks. That remains true. These charts are a perfect example of that. The longest term trends in the Australian dollar and the New Zealand dollar relate to their interest rate position vis-a-vis the US Fed. So what would have permitted or fostered these rather astonishing rate differentials in the currencies? Let's see if it's what we might suspect. I don't think it is, but let's take a look. It's Australian CPI. The chart is not dissimilar to the chart of US inflation throughout the same period. It's a little bit higher overall, but not much. It's certainly nothing like the type of differential in inflation rates that would produce the types of spreads over 3 and 4 years that the Australian dollar deserved over the US and the Fed. And the reason is back here. Where's my GDP chart? Here we go. Through the period here, when we're seeing much stronger both Australian dollar and New Zealand dollar and interest rates, what is happening? We know that the economies in Western Europe, the United States, and Japan, although for Japan it's not a new story, did not recover very forcefully from the recession and the financial crisis. What else do we know? That China started spending enormous amounts of its trade profits on propping up its economy. Now take a look at this. China's been doing two things since the financial crash. Well, since 2010 anyway. Immediately upon the financial crash, it did what everyone else did. Pumped money into the economy, did it by different means, but nevertheless, that's what it did. And somewhat surprisingly realist, because that particular level line in the white Yuan line on the chart is a line that goes back to 2008. The Chinese had been devaluing their currency, or actually revaluing their currency, making it stronger, prior to the financial crash. At the financial crash, they froze it at about 6.8 something, which is the line you can see on the left in the white. And then they began to let it appreciate. So it went from 6.82 maybe down to just above 6.0. They have since then, since early 2014, completely reversed that. So two things are going on in China, two big macro moves. The Chinese are spending money. I didn't put up a chart of their new loan creation, but it's been enormous. In fact, this past January, it was the largest number ever in the Chinese economy. And they also have been reducing the value of the yuan. Both things designed to do one thing, which is support the Chinese economy and do not let its workers get restive. So as it relates to the Australian economy, if as the West, and I use that term not in any exclusion sense, if the United States and Europe and Japan are not drawing in resources, and if despite their central bank's best efforts, meaning the US Fed at 0.25% for close to 10 years, their economies still have not really recovered from the recession. Australia and New Zealand had a place to shift their efforts to. And that is really the story behind the Australian New Zealand dollars, the currencies down under, over the past decade. As resource economies, they were able, in a very rapid fashion, to shift their products, their resources, from a damaged and haltering West to a new consumer. The new consumer, of course, being China. So if we remember the macroeconomic background and the movements between, or the cycles, if you will, of development between countries, the movements of the Australian and New Zealand dollar are no longer remotely inexplicable, excuse me. One of the reasons they've come off is on this chart. If China is devaluing its yuan, there's not only, of course, against the United States dollar, but it's against all currencies in the world, then in order for Australian and New Zealand products to remain competitive as exporters, what has to happen? Exactly what we've seen. The decreased value, competitive, if you will, of the nation's currencies. Because on a commodity basis, what are most commodities based on? Well, they're based on dollars. So if China is devaluing its yuan and Australia is not devaluing its Australian dollar, then and Indonesia is devaluing its rupiah, then quite obviously Australian iron ore becomes a good deal more expensive for Chinese smelters and Chinese steelmakers than its competitors. So once China began devaluing its yuan, and the Chinese yuan devaluation is a managed affair. It looks like there are a lot of curves on that white line there, but there is a particular uniformity in its behavior. So if and when China began devaluing its yuan, that was a determining factor for the currencies from New Zealand and Australia. Remember the song, I come from a land of plenty. They do. As long as there is a new center of economic development to move to, and to provide resources for development, then the Australian and New Zealand economies will grow at faster paces. That is not a judgment, that's simply an empirical fact. Okay, folks, I thank you all very much for attending. I hope this has been useful. We will do it again next week. I have a question. I actually speak to some of the people at FX Street next week because I usually do my webinars on Monday, so we'll probably do one on Monday, and then I'll be here at FX at Worldwide Markets for election coverage on next Tuesday. So I thank you all very much for attending. I hope you all have a very good day, good afternoon, good morning, and good evening, wherever you happen to be. Take care.